Comparing factoring and line of credit.
Choosing the right financial tools is the key to maintaining a trucking business success and growth. The contemplation to use factoring versus line of credit is a constant debate, whether those are two very popular methods of financing. We'll look at the differences between factoring and lines of credit, the pros and the cons, so you can make the best choice for your business.
What is a line of credit?
A line of credit is a loan type where a person can borrow a predetermined amount of cash for a fixed period.
A lending institution, such as a bank, approves a line of credit for a client, providing a maximum credit limit and allowing this person or business to use the money to pay for goods, services, or freight.
Now let's talk about pros and cons of lines of credit.
One of the main advantages is availability. This is beneficial if you have a financial emergency or an urgent need, so you can access funds immediately.
Another advantage is that you only pay back the amount that you used, not the amount that was allocated or approved.
In addition to these, a line of credit allows businesses or individuals to build a favorable payment history that appears on the company's business credit report. This means less effort obtaining potential future credit and better credit worthiness.
Although this method of financing has several disadvantages, which may be weighed against the potential benefits.
A line of credit typically has strict repayment schedules that may be difficult to keep up with. If you fall behind, the lender may charge late fees, which can cause a big financial headache.
Another disadvantage to this line of credit is that users typically fall into an endless loop of borrowing and reborrowing that could be difficult to escape.
Interest can add up quickly, and taking on additional debt could put an even bigger financial strain on the individual or business.
It is important to remember that a line of credit is not a free loan. Even with potential low interest rates, there are still some consequences to consider.
If you choose a line of credit without an option of putting down any collateral, such as a home or vehicle, you're not risking those assets, but it can lead to higher interest rates,
making the line of credit a more costly choice and an unsecured financial method.
How does a business line of credit work?
A trucking business line of credit works similarly in the same way as a traditional credit card or loan. It is a line of credit available to businesses in which the bank provides a certain amount of funds and which the business can draw on whenever needed. As a company borrows from the line of credit, it must repay in full the borrowed amount plus any accrued interest. Anytime a borrower requires money, it can be drawn from the line and the available credit will be reduced. Once a remittance is paid, the available credit increases again.
Repayment terms are typically also very flexible, meaning more allowance to the borrowers to make interest-only payments during some periods or defer payments during the whole period of loan duration.
This also makes it easier for borrowers to make a payment plan, and that's determined on their individual circumstance.
These tools make it easier to manage longer-term financial needs, such as seasonal expenses, unexpected purchases, or investments in transportation.
What is factoring?
And one of the most favorable financing options is factoring. It enables companies to sell their unpaid invoices for immediate cash to a third-party vendor.
Factoring is a financial option for contractors to get the cash they need to purchase materials or expand their business. Factoring companies buy invoices and pay for them immediately, allowing contractors to have access to capital quickly.
Factoring services are attractive to businesses because you can access your funds faster than a traditional loan, and they also offer flexible repayment terms. Let's compare these two types of financing.
You need to provide financial information about your customers to the factoring company for review before it chooses to fund the invoices to your company.
In the case of a trucking business's line of credit, it is typically your payment history, your credit, and your financial information that is reviewed. Selling receivables to a factor makes factoring the easiest way to receive cash quickly.
Factoring provides an immediate cash boost that can be used in contingency for new orders or capital expenditures. In contrast, receiving cash from the customer via a line of credit can take up to 90 days.
Factoring ensures that a trucking company receives steady cash flow allowing them to cover their expenses.
Here again, a line of credit may involve unpredictable payment schedules and fluctuating interest rates, making it challenging for trucking companies to manage their cash flow efficiently.
It should be noted that the review for a line of credit should be conducted by a third-party vendor.
This extends the review time and can cause you to wait longer for the final decision. Factoring offers instant access to usable capital. As soon as the freight is delivered and the invoice is generated, trucking companies can submit it to the factoring company to receive immediate payment. It ought to be noted that a line of credit may require extensive paperwork, credit checks, and collateral,
leading to potential delays in obtaining funds, so the wait time may take a little longer. All communications with your customer is usually handled directly by the financing company when the invoice is sent, so you're not held responsible for any collection issues.
On the other hand, in the case of the line of credit, your customer has nothing to do with the arrangement whatsoever.
In the case of factoring, you do not need to create an invoice and bill the customer every time to receive a payment.
Instead, you have to submit the paperwork for each load. For example, simply sharing the docs images from a mobile phone, and it is the task of the factoring company to send the invoices to the customers. Getting access to your funds is really going to be that easy, and you can immediately proceed with your payments to drivers, brokers, or owner-operators. That said, a line of credit can be used anytime if opened. However, in this case, the client has to issue an invoice.
Both financing methods have flexible credit limits, but they're just based on different rates. When summarizing the key points between factoring and line of credit, we may note the following.
A factoring credit limit and financing are based on the creditworthiness of the trucking company's customers, not the credit history of the trucking company itself. This can be beneficial for trucking companies who have limited credit or a less than perfect credit score. A line of credit is based on the trucking company's financial statements. Creditworthiness assets typically requires a strong personal credit score and may require personal guarantees,
which can be challenging for truck companies, especially those starting or expanding their businesses. Ultimately, the line of credit and the factory financing option can be powerful tools if they're used responsibly, but if not, they could lead to difficulties.
As with any loan, it is important to weigh the pros and cons carefully before taking on this kind of debt, and make sure you fully understand the repayment schedule. That way, you can get the most out of a line of credit or factoring with HMD Financial and minimize any potential drawbacks.